One of the main questions that has come up from people that I've been talking to is, are we now in a recession? And the difficult way to, or yes, according to most of the industry experts, we are, but it's not like what we typically think of in a recession. And what I mean by that is a recession is usually defined as 2 consecutive quarters of negative GDP growth. And we haven't had that. We haven't had that completely as of yet, as we haven't had 2 complete quarters since this started. But there is no doubt the economy is shut down. With the stay-at-home order in place and people not being able to go out, there's not a whole lot happening out there. So with that in mind, GDP has basically gone rapidly into negative territory. But saying that, when we talk about recessions, what I'm trying to point out here is there's usually 3 types of recoveries that happen. One is more known as an L-shaped recovery, and that's you went down into the recession and then you kind of flatlined for a while, and typical of what happened in like the Great Depression. It was a very long period of time with negative economic activity. More typically what we see is what's known as a U-type of recession or U-type of recovery. And that's activity goes down, it kind of flattens along the curve at the bottom, stays there for a little bit, and then starts to come back up out of that. The graph I have on screen here that I'm showing you is what this recession is according to Goldman Sachs, JP Morgan, and Morgan Stanley. So you've got a lot of the large investment banks here, and what they're calling for is what's known as a V-type recovery. And that means you had an event that led to a rapid drop-off in economic activity. And as soon as you're past that event, you're going to see economic activity spike. It's going to recover very, very quickly, hence the shape of the V in the graph. So we do have unanimous consensus here from the main investment banks that this is what we are going to see, with the expectation that the 3rd and 4th quarters are going to be very strong. So why are they thinking this, or why is this what they're looking at? Well, this slide here is from the Harvard Business Review. And what the Harvard Business Review have done is they've gone back and they've looked at prior shock events. Okay, so a pandemic, as in this case, is basically considered a shock event. 9/11 was a shock event. There weren't any underlying things that led up to it. It was an event. And that's a little bit like what you have here. And when they go back and look at prior pandemics, such as SARS, such as the Hong Kong flu of 68, the Asian flu in 58, and all the way back to the Spanish flu in 1918, the economic recovery followed that V-shaped graph that I showed you before. So, history usually is a great indicator of what's going to happen going forward. Since that is what happened in these type of events in the past, that is actually what they're looking at with regards to the future. With that in mind, with the expectation that we will see an economic recovery bounce back very quickly, and you consider the fact that the underlying basics of the housing economy, the housing market in general, were very strong, driven by low interest rates, driven by low supply, high buyer demand. The real estate market was in great shape. And that is actually what John Burns Consulting is seeing as well. So in here, they're looking at the fact that when you have a V-shaped recovery to an economic event, there is usually little to no damage to home prices. And the reason for that is it happens fast. So it's not this prolonged, drawn out event that we have seen on some of the big recessions that we've had in the past. And as they say, their research team has showed that what is happening right now is playing out very, very similar thus far. So with that in mind, I move on to the Z report from Ivy Zelman. It's a well-respected report that a lot of industry people use to kind of gauge what is happening overall. And what they're saying is that, like I just mentioned, the overall dynamics of the housing market were strong. This was not a housing crisis that has caused anything. It's a health-related crisis. And considering the historically low interest rates and the low inventory levels that we had, they're not downplaying the fact that this will absolutely impact the market, but they don't think it's going to have a long-term negative impact on pricing. As a matter of fact, they don't actually think it's going to have a negative impact on price appreciation, meaning home prices coming down in any way, shape, or form. What they do think is going to happen is they think the pace of appreciation that had been expected is not going to be achieved. That is actually going to be reduced. And on this next slide here, it kind of shows that. This is showing that prior to the outbreak of COVID-19, the Z report was estimating the national average price appreciation for 2020 to be 4.7%. They've revised that down to 3%, but it's interesting that in 2021, they've now actually revised it up. Now, although they didn't have a pre-COVID-19 forecast for 2022, Fannie Mae, Freddie Mac, National Association of Realtors, they all did. And they, again, were showing strong price appreciation going forward in 2021, 2022, and even 2023. Now, with all that in mind, the other question that naturally comes up is unemployment. We have had record low unemployment. So if people aren't employed, it has to affect home sales. I mean, that would be the natural way to think about it. If people don't have jobs, they can't afford to buy a home. And the interesting thing is, there is actually no direct relationship, no direct correlation when you go back 30 years between unemployment rates and home sales. And to a certain extent, that seems a little bit counterintuitive, but when you start looking at the types of industry affected, in this case, so far, obviously the service industry, has been absolutely decimated. Hotels, restaurants, the airline industry. But a lot of other industries they're coping all right. I mean, there's a lot of companies out there that will be able to transition to this, having people work from home, conducting Zoom meetings, other things like that. And it has been business as usual. Obviously, certain parts of the manufacturing, if you make toilet paper these days or paper towel, your business is booming. And a lot of those industries have been hiring an awful lot of people. So here's what I mean by that. If you go all the way back to 1991, we had rising unemployment between 91, 92, 93. But as you can see here, with the rising unemployment, home sales actually increased. Okay, you go then to about 2001 through 2003, 2004, you had rising unemployment, but home sales also increased. Now, what's marked as number 3 on this graph is actually the Great Recession from 2007, 2008, 2009 in there. Now, the reason those bars are grayed out is because we need to remember that the recession at that time was caused by housing. The mortgage industry completely melted down. Nothing made any sense at that time. I was doing real estate at that time, and I can remember, there was plenty of inventory available, but anyone and their brother could get a loan. And you had this rapid frenzy of people buying for buying's sake. Investor activity was through the roof, and it was pandemonium. I mean, literally at that time frame, people scrambling for new construction, and the minute the house was built, they were going to turn around and sell it for a profit, and the market just kept going up, 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 and it was artificial. Hence the bubble. It was just an artificial. It was not based on what we would normally see with regards to supply and demand. And in that case, when unemployment did go way up, home sales did drop off. But with home sales dropping off, the other factor to keep in mind there is that the lending standards went extremely strict. We had clients at that time that still were employed. They had good jobs. They had 20% down payment. They couldn't get a loan. They were denied. They had great credit. They were denied. It was very, very difficult. You had to fit in a very small box in order to be approved for a loan. So the lack of mortgage availability led to a decline in home sales. Now, likewise, when you go to number 4 here on the graph, it's interesting. From 2015 to 2019, we've had falling unemployment, but we haven't had a rapid increase in home sales. And that's simply due to supply and demand I was just referring to. As many of you know that may have been looking for a home, there isn't a lot for sale. You know, homes were getting 15 and 20 offers each. There was a lot, or there has been just an unbelievable amount of demand with very little supply. Again, that's why the basic underlying factors of the real estate market right now have been very strong. Now, to that point, here's the last slide I'm going to show you today. You can see here, this is a look at inventory going back. Okay, and you can see here in about 2005, we started to see inventory rise above what is considered the neutral balanced point of the market and increase rapidly through 2008. You know, nationally here, we're talking 9, 10, and 11 months supply. There was no reason for the frenzy of buying activity and the price appreciation, the rapid price appreciation to take place at that time. Supply was plentiful, so it shouldn't have been happening. You know, again, the bubble. You see that inventory fell off rapidly after 2008. That's due to the foreclosures. That's when the banks were taking properties back left, right, and center. I did foreclosures during that time, and it was, you know, quite often we'd have 2 and 3 new homes a day to go and check for the banks that were coming back. Those foreclosures started coming back onto the market, which is what caused the spike in inventory in 2010. But since then, for the most part, inventory has been consistently falling, especially when you look at the last few years, 2011, 12, 13, all the way up to today. We are basically looking at record low inventory. Nationally, as of when this chart was done, it was at a 3.1 month supply. Now in North Texas, Frisco, and in Southern California, mainly Temecula, where my teams operate, it's even less than that. We've been running at about 1.5 to 1.9 months worth of inventory. Very, very low. So with that in mind, you have this situation where the underlying factors of real estate remain strong, which is why from the previous charts and graphs that most of the economists believe that the housing market is going to bounce back relatively quickly as soon as we're past this. I mean, the good news this morning that I saw is that it's looking as though, you know, new cases of COVID-19 are starting to slow. The number of new infections are starting to slow. And they're expecting we'll see the peak of it in the next 7 to 10 days, which is, you know, I definitely hope for everyone. And with that in mind, and as the restrictions come off and we can get back out there, personally, I think employment's going to come back. I'm going to go into that more probably next week on unemployment. The latest forecasts I've seen are showing unemployment levels falling rapidly starting later this year and continuing into 2021 and 2022. But hopefully this gives a little bit of perspective from the research that I've been doing on what we are seeing and what I'm expecting going forward. Now, if you have any particular questions, you know, you'd like more information about any of this in detail or more detailed information, please feel free to reach out. I'd be happy to talk to you, and together we will get through this.